The Indian stock market indices comprise the Sensex and the Nifty. Even if you don't pay attention to the stock market, you've probably seen these two terms in the headlines of financial websites, news networks covering business, and pink publications virtually every day. But what are the Sensex and Nifty indexes, and what place do they hold in the stock market? In order to comprehend stock market indices, one must first have a basic understanding of stock exchanges. They include shares, bonds, derivatives, and commodities. All can be traded on the stock market, such as the Bombay Stock Exchange or the National Security Exchange. To put it in another way, a stock market index measures the performance of a particular stock exchange, which is a valuable indicator of the overall health of the financial market or even the economy. When Nifty or Sensex goes up or down, it can either be a sign of how well a particular stock is doing in its portfolio or how well the rest of the financial market is doing overall. Many factors can lead to the stock market's collapse, such as an economic downturn, an epidemic, another natural calamity, or even the rupture of a long-term financial speculation bubble. To understand the Sensex, you need to grasp what the two words that make up the acronym mean: sensitivity and index. The BSE was established in 1875, making it India's first and Asia's oldest stock exchange, as well as the world's fastest stock exchange. Formed in 1986, the BSE Sensex, also known as the BSE Stock Market Index, is an index that tracks the performance of 30 well-established and financially solid Indian corporations. The stocks of these 30 businesses, which represent a cross-section of India's industrial sectors, are among the most traded on the stock market. There are 30 publicly traded firms that make India's 30-share Sensex Index, which analyzes these companies' price changes. How do the members of the Sensex get chosen? Sensex requires that each company meet some criteria in order to be considered for inclusion. To start with, a company must be listed on the Bombay Stock Exchange. There can be no Sensex entry without the company being traded on the Bombay Stock Exchange. If it isn't listed and actively traded on the BSE, it can't be included in the Sensex Index. The second criterion is that it must be a large or medium-sized business to be eligible for inclusion in the Sensex. In order for Sensex to include only the best and largest companies, this condition must exist. The third criterion is that it must have shares that are easily traded. A company stock must have a high level of liquidity. To put it in another way, buying and selling such stock should be simple, and traders need not struggle to find information about the company. As this liquidity is a result of the quality of the company's underlying business, this also functions as a screening factor to allow only those businesses whose business quality and hence their shares' liquidity is high enough. Another condition for a corporation to be included in Sensex is that its primary activities of business provide substantial revenue. A wide variety of businesses have been divided into various sectors based on the primary operations they perform. The Sensex members must maintain a sectoral balance that is roughly in line with the Indian stock market. Each sector of the economy is assigned a specific weight when creating an index. Financial services, for example, tend to be the most heavily weighted in various indices. Even after being included in the list of 30 firms included in the Sensex, each company must ensure that the balance of its industry is maintained. Additionally, the Sensex weightings are determined by the free float market capitalization of the companies that make up the index. Basically, if Sensex rises, it means that the stock prices of some or all of the main BSE businesses would rise as well. However, if the BSE Sensex falls, it also signifies that the stock prices of some or all of the top BSE stocks have fallen. What are the best ways to invest in the Sensex Index? In order to invest in the Sensex, there are two options. To begin with, you can buy equities directly in the same proportion as the Sensex. You can begin investing in the Sensex components and their relative weighting right away. As a result, you can simply buy the stock in the same amount as its weight in the index. The other option is to invest in the Sensex is through the index mutual funds. The portfolios of these funds are identical to those of the underlying index. Consequently, the 30 companies in an index fund that tracks the Sensex will have the same weighting as the Sensex itself. Index funds are managed in a passive manner, which means they invest in the same kind of securities as the underlying index, in this case, the Sensex. There are no changes to the portfolio composition by the fund manager, and the fund strives to provide returns equivalent to the index that it tracks and aims to mimic. What is Nifty? To get the name Nifty, you simply combine the words national and 50, which are the names of the 50 most frequently traded equities on the NSE. On the National Stock Exchange of India, it is known as Nifty 50. As the largest and most liquid Indian securities, blue-chip businesses' performance is tracked by this index. The NSE now has around 1,600 listed and non-listed firms that are eligible to trade in this index. There is approximately 65% of NSE's float-adjusted market values held by companies in Nifty 50. Because it includes the country's most important economic sectors, it gives investment managers a comprehensive view of the Indian market. Benchmarking, index funds, and derivatives based on the index have all been popular since it began trading in April of 1996. What qualifications must a company meet to be a member of the Nifty 50? It is necessary for a stock to fulfill certain requirements before it can be considered for inclusion in the Nifty 50 index. One of the requirements is that it must have a market capitalization that is at least 1.5 times the average free float market capitalization of its smallest member. In order to meet the second criterion, the asset must have traded at an effective cost of 0.50% or less in 90% of the observations for a portfolio worth 10 crores. Another requirement is that the company's trading frequency must have been 100% throughout the previous 6-month period. The fourth and final criterion is that a firm must meet a few listing history standards in order to be eligible for inclusion in the Nifty 50. Even after the index has been constructed, it is recalculated every 6 months using data from the 6 months periods ending in January and July, respectively. Nifty 50 stock replacements, if any, are normally effected on the first working day following the expiration of F&O contracts in March and September. Market participants are given at least 4 weeks' notice before any changes are made to the index. Indices are also assessed for compliance with the SEBI's new portfolio concentration rules for ETFs index funds on a quarterly basis. What is the most effective strategy to make investments in the Nifty index? Since the index's inception on June 26, 2009, it has been produced in accordance with a float-adjusted market capitalization-weighted methodology, according to which the index's level is decided by the total market value of all the stocks comprising the index since then. Changes in index constituents as well as business activities such as stock splits, rights issuances, and other similar events are taken into consideration by this technique without causing the index values to alter. Also, the Nifty 50 index is based on data from November 3, 1995, the day after the NSE's capital market segment celebrated its 1-year anniversary of existence. It has been decided that the base value of the index will be 1,000 and that the base capital will be 2.06 trillion. However, SEBI has directed that all benchmarks be switched from the price index to the total returns index as of February 1, 2018. Due to the fact that dividends are supposed to be reinvested into the index, the TRI is believed to be more accurate in its calculations. As of the 4th of April on the daily chart, a lengthy bull candle was created which indicates an upward breakout according to stock market analysts. This is a promising sign and the price may rise more in the near future. What are the uses of the Sensex and Nifty indices? The market's general health is gauged by looking at the performance of Sensex and Nifty, two widely followed indices on India's stock exchanges. BSE and NSE both utilize these indices. There are indices that track changes in stock prices, and these indexes are commonly used as a gauge for market sentiment. Mutual fund managers frequently use the Nifty and the Sensex as yardsticks to gauge their fund's progress. Sensex may be used as a benchmark index by some mutual fund institutions, while Nifty is used by others. There are a number of elements that come into play while making a selection, including the fund's house's sectoral or thematic strategies, asset allocation, and investing aim. That's all from this video, and make sure to leave a comment and share the video. Thank you for watching. We'll see you in the next video.